and achieving new milestones which will drive transformation over mid to long term. We continue to serve communities and fulfill our purpose of meaningful ways. I now request Gandharv to take you through our earnings presentation.
Thank you, Inderbhai. As you all are aware, the business environment has been very dynamic in the previous quarter. Despite that, we have been able to achieve decent performance owing to resilient business model. On the good side, construction activities continued for better part of the quarter, albeit at a slower pace. All thanks to a calibrated approach taken by government in terms of lockdowns. Project and industrial activities started trending up as case load subsided from its peak. Our learnings from the past also helped us improve our supply chain and production, which remained largely unaffected. Consumer sentiment remained positive, and we believe there could be some pent-up demand in coming quarters. On the flip side, raw material volatility continued. The inflation in our input basket was in low teens during the quarter, and our blended price hike was in high single to just double digit. In mid-June, sharp correction in copper prices caused further complications to an improving demand scenario as dealers refrained from stocking in anticipation of price cuts. Accordingly, inventory levels in distribution channel dipped significantly, with secondary sales tracking ahead of primary sales. Though we believe this is a temporary sentimental setback and primarily will eventually catch up with underlying demand. Nevertheless, July seems to be panning out better than previous months. Retail outlets across the market are largely open at the moment and activity is picking up. We continue to believe that second half is likely to be better than the first half of the year, similar to last year. Of course, and assuming that third wave, if any, doesn't severely impede the economic progress. Moving on to presentation with slide 4 for the quarter ended June 2021, our consolidated revenue was up by 93% year-on-year. EBITDA increased by 144% year-on-year with 153 basis improvement in margin. Cost-saving initiatives were more than offset by unfavorable operating leverage and input cost volatility. This limited the EBITDA margin to 10.3%. Having said that, I would like to reiterate that the right way to analyze our operating profitability would be on an annualized basis, as several dynamic factors can weigh on quarter-to-quarter margins. Our staff cost at rupees 959 million, or 5.1% of sales, was higher than last year, but broadly at par with Q4. A&P spent at rupees 78 million, or 0.4% of sales, were optimized considering the subdued business environment seen in Q1. Our finance costs at rupees 122 million were lower by 25% year-on-year. Other income at rupees 253 million was down by 25% year-on-year due to one-off interest income gains in the base quarter. A detailed breakup of our other income and finance costs has been provided on slide 12 of our earnings presentation. Our profit before tax at rupees 982 million was up by 151% year-on-year, while PAT at 1053 million was down by 36% year-on-year, again on account of one-off gains in base quarter as explained on slide 9. Normalized PAT is 10x of last year. PAT margins in Q1 stood at 4.0% against a normalized margin of 0.8% in the same quarter last year. Moving on to segments. On slide 5, wires and cables revenue doubled over the last year despite the multiple challenges. In domestic business, cable outperformed wires in Q1, but that was partly on account of relatively favorable base. Distribution as well as institutional business grew over 100% year-on-year, with institutional being marginally better again on softer base. Though from an overall market perspective, we believe the institutional business still continues to remain subdued due to relatively lower number of large-scale projects. As I mentioned earlier, in June we saw sharp correction in copper prices. This impacted the trade sentiment, particularly for primary sales of retail wires, just when markets had started to open up. Export business grew 12% year-on-year. The share of overall revenue improved sequentially to 6% in first quarter versus 4.5% in previous quarter. The growth was driven by Asia, Australia, UK and Africa. Logistical challenges due to shortage of containers globally continues. Overall segmental profitability for wires and cables was impacted by raw material inflation and adverse operating leverage. On slide 6, FMEG revenue increased by 39% year-on-year. The business momentum was affected by closure of retail shops across many large cities. Distribution expansion continued with greater thrust on digital marketing campaigns. Innovation-driven product development and improving competitive positioning remains key focus area. We have a healthy pipeline of new products across categories. Fan, which is our largest category in FMEG, grew in healthy double digits. However, lockdowns in April and May, which are key summer stocking periods, impacted for a second consecutive year. Within fans, portfolio mix continued to improve towards premium. Light business grew with higher emphasis on augmenting portfolio across price pyramid. Switchgear saw strong growth, however, switches remained subdued. With learnings and success from strategic intervention in switchgear, we are now in process of integrating switches with light business, which will help us unlock synergies through operational advantage and distribution overlap. Solar and conduit pipes saw healthy traction. Overall, segment profitability was largely impacted by adverse operating leverage. Raw material inflation is being counterbalanced by pricing action and cost consciousness. While many of you may be aware of this, but for the benefit of larger audience, I would like to update you all that last month we acquired Silvan Innovation Lab. It is a Bangalore-based technology company focused on providing cutting-edge automation offerings for homes, offices, banks, retail outlets, hotels, and other spaces. Silvan pioneered the concept of home automation in the Indian residential building market and has a proven track record with many prominent real estate developers. Acquisition of Silvan augments our R&D and innovation capabilities. It will enable us to address evolving consumer needs. Home and Silvan put together gives us strong foothold in IoT space and is in line with our ambition to become a forefront consumer-centric company. Moving to slide 7. Other segments, which is largely our strategic EPC business, clocked rupees 575 million revenue, up by 19% on year-on-year basis, but decreased by 25% on a sequential basis due to impact of pandemic. Segment margin stood at about 11%. This copper segment, as disclosed in the financial results, largely reflects Riker base, which is a part of our backward integration initiative. We continue to explore options to improve utilization rate at Riker plant in order to optimize production cost structure at Riker. Moving on to financials from slide 9 onwards, our net cash position stood at over 6.7 billion as of June end, which was 3.3x of same period last year. Working capital is a mixed bag. While receivables levels have been quite good, inventory levels were higher than normal as we were anticipating better demand scenario in June. Our numeric distribution metrics continued to trend positively. Even during lockdowns, we were able to onboard many new dealers, especially on the B2C side. Project Shikhar, which is implemented in 5 markets in its first phase, is helping us penetrate new retail outlets and improve shelf space. This was supported by aggressive digital marketing campaigns, which helped in increasing brand awareness and connect with consumers. These campaigns across digital formats have cumulatively made over 24 crore impressions during the quarter. Project Leap continues to make good progress, and we hope to share some updates in the next quarter. I'm also delighted to highlight that our power cable test laboratory at Halol is accredited by National Accreditation Board for Testing and Calibration Laboratories, or NABL. It is possibly the only private laboratory in India having a wider scope of more than 4,000 plus tests covering multitude of national and international standards. It is also the first laboratory capable of testing a single cable length from 50 meters to maximum to 4 kilometers. The test certificate issued by this lab would be accepted worldwide as per the agreement with NABL. Lastly, given the kind of building blocks that we are putting in place and our strong brand equity, we are very optimistic of a stronger performance on top line as well as bottom line in the coming quarters particularly the second half of the year. With a clear strategic focus, we remain excited about our future growth prospects. With that, I conclude my opening remarks, and we will be pleased to answer your questions now. Over to you, operator.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ravi Swaminathan from Spark Capital. Please go ahead.
Hi, sir. Thanks for taking my question. My first question is with respect to the price hikes that on a blended basis that we would have taken over the past 6 months in the cables and wires business.
Thank you, Ravi. Ravi, you know our business model. In the case of cable and wires business, generally, we revise our price list on a monthly basis. And there are 2 variables which are considered while deciding the price list. One is the increase in average copper LME prices in the previous month. And second is change in the foreign exchange rate. Both were considered even in the current quarter. On a blended basis, the raw material cost would have increased by, in early teens, whereas the price hike which we have taken is just touching the double digit. So there is a bit of a negative delta there, which is also getting reflected in the contribution margin in the current quarter period.
Got it. Would we wait for commodity prices to cool off over the next 6 months, or is it likely that we will go ahead and take the differential price hike which is yet to be taken?
Yeah, so the model which I just elaborated is essential to our business. So we will continue to follow the same model. But Ravi, you and me have discussed this several times. In our business, what happens is on a quarterly basis, there are at times some dynamic factors which can weigh in on quarter-to-quarter margins. So that's the only thing. But if I were to take an analyzed view, I don't expect any material change in the contribution margin. And if you recollect, even last year, first half, the contribution margin and EBITDA margin was slightly softer. But in the second half of the year and overall for the entire year, it was comparatively a better number. So we'll have to at times take a analyzed view. But directly, I believe that in quarters to come, particularly in the H2, the numbers are going to be relatively better than what we are seeing today.
And with respect to the FMEG business, so basically, there has been an EBIT level loss that has been there. Is it because of the fact of lack of operating leverage, because of lower than par, or because of a combination of also delays in taking price increases across products? So you can continue.
You're absolutely right. It's primarily because of negative or adverse operating leverage. One of the reasons is the employee cost. Ravi, you would be able to recollect that last year we didn't offer any increment to our employees, whereas in the current year we have given that. And partially it is more like a 2-year increment rather than a single-year increment. So that is where the fixed cost for the corporate laborers as well as our employees has gone up. The second one is the A&P spend, though it was calibrated, is slightly higher than the base quarter, and which is also getting reflected because A&P is primarily attributable to our B2C business, not to B2B business, and that is where these numbers are located to the segment. So these are the 2 main reasons: operating leverages because of fixed cost and as well as A&P. On the contribution, there is no significant or material difference.
Okay. Got it, sir. And my final question is with respect to the capex, sir. So next 2 years, that is FY22 and 23, what kind of capex are likely to do? Will it be the 300 crore range per annum?
Absolutely. So in the current year, we are anticipating almost 300 crore rupees of outflow. In the current quarter, we would have incurred close to 80 crore rupees or thereabout. And next year, I think it's slightly early to give any guidance. We'll probably wait for a couple of quarters towards the end of the year. We'll come back to you for the next fiscal. But this fiscal, I think, should be around 300 crore rupees broadly.
Okay, sir. Thanks.
Thank you, Ravi.
Thank you. Before we take the next question, we'd like to request participants to please limit your questions to 2 per participant. Should you have a follow-up question, we request you to rejoin the queue. We take the next question from the line of Naval from MK Global. Please go ahead. Mr. Naval from MK Global, you may go ahead with the question.
Yeah. Am I audible?
Yes, sir. Please go ahead.
Okay. Thank you for the opportunity. Gandharv, I have a couple of questions. First, if I compare your FMEG revenues with the, market leader who also reported numbers yesterday, on a higher base, they are like flattish on 2-year CAGR, and we are like down around 11%. So on a low base also, this is a weak kind of number. So can you elaborate, was this because of regional specific things where you are, heavy on West and West was more impacted with Maharashtra for lockdowns, or, there was something else over here? So that is my first question.
Thanks, Naval. So, Naval, we are, in this business since last 6 years. Comparatively, we are a smaller player. The industry size is almost 60,000 crore rupees. And we did almost 1,000 crore rupees, which is around 1.5% of market share we have across several product categories. Within that, the largest is fan, and fan sales got impacted because of localized lockdown in this particular current quarter. So that's there. And second is, since our base is growing year after year, you would have seen the revenue CAGR is hovering between 35 to 40% over a past 5-year period. That is also impacting the overall number. But, on the growth of B2C business, including FMEG and retail buyers, we remain positive. The projects like LEAP are also going to help us in augmenting the top line. We are in the process of augmenting the distribution, more particularly on the smaller towns. And in the quarters to come, I'm sure these initiatives, for example, LEAP or Shikhar, would help us in improving the overall top line. That was the distribution side. On the product side, the brands like Home or the Silman acquisition, which we have done recently, would also help us in augmenting the product portfolio, and we would be able to get into the premium product categories because IoT is going to be a premium offering. So overall, looks like that we are here to experience the best of consumer business, both at retail wire as well as FMEG, and we remain positive on both these businesses.
Okay. And second question on other operating expenses, although you have given the schedule, so any specific reason sales are down 38% sequentially while other operating expenditure down only 18.5%. So, if you want to give your insights, whether this is one-off and operating leverage will bounce back strongly once the revenue recovers, or there was something else to it.
You're right, Naval. Primarily, it is operating leverage only. Because as I mentioned to Ravi also in the previous question, the increase in fixed costs in the form of employee remuneration as well as payments for contractors was affected from the current quarter, whereas the top line was not necessarily good from that perspective, and that is where it has impacted negatively on the operating leverage. Other than that, I don't think there is any specific line item which requires a specific mention. Other expenses are broadly in line with what we had anticipated.
Understood. And lastly, can you give your insights on region-specific momentum in sales or demand recovery, what you have seen in 1Q, East, West, North, South, and how they are trending in the current quarter?
So, as far as current quarter is concerned, it's too early to comment. Barely 20-21 days, but sequentially it looks like that the current month is better than the previous month. And the other thing which I should clearly call out is that not necessarily reflective of the overall monthly performance, because not necessarily 20 days would be reflective of the entire month's performance. On the regions, I think South got impacted. Other than South, all other regions have done well. And South, I think we can attribute to the localized lockdown which were there in the southern states. But other than South, I think almost all the regions have recorded significant growth across all the product categories.
Got it. Thank you. I'll come back in the queue, and all the best for ensuing quarters.
Thank you, Naval. Thank you very much.
Thank you. The next question is from the line of Dhaval Shah from Girik Capital. Please go ahead.
Hello. Yeah, hi, sir. Sir, can you give us your outlook on the wire and cables business separately? What do you think about each segment? And also, you mentioned the institutional demand is lower. So just more clarification on that. And just more of the demand levers for the cables business, given the spending by the government is going on. There are a lot of spending happening on the solar park as well. So I assume there will be some new demand coming from that segment as well, and we are leaders. So what sort of demand visibility do we have for this year and the next year, along with exports? And then I'll come to the second question.
Sure. That's quite comprehensive. Thanks for asking. Let me talk about the macro drivers. Cable and wire, if you visualize, are consumed in almost all the sectors. So think of any infrastructure, any new expansion, greenfield, brownfield, any new office, everywhere you will need cable and wire. And we are the only company in the country which can provide all types of cables and wires. And our distributors are well placed to attend almost all the requirements which a consumer would have. The other thing is, generally speaking, we have ability to provide the required material almost there just in time or within a day or two, and that is a significant differentiator between us and our peers in the industry.
Yeah.
You are aware about the initiative that the government is taking in terms of reforms. I would not like to spend time on that in this call, but I'm sure you're well aware about that. That will continue to help us in improving the GDP, the overall consumption of cable and wire, and help the sector as well as a company like ours, which is a market leader by far. On the supply side and the DTM side, what we are doing as part of Project Shikhar and Project Leap is we are focusing on increasing our reach, increasing our number of dealers and distributors, catering to the requirements in the geographies where we don't necessarily are present or are currently under index, for example, smaller towns. And both the government initiatives and our initiatives in penetrating the market would help us in improving the rate. You would have already seen our March presentation where we have talked about that cable and wire we expect to grow on a 5-year basis at 1.5x of the industry growth. And it could differ from a year to two, but overall on 5-year horizon, we are hopeful that we will be able to do that. And that is why we are working with BCG under the Project Leap framework to do that. So that was on the overall, cable and wire.
Correct. So now, like if you look at FY20, we were at like around 7,500 crore top line. Now, and 21 was 7,600 crore. So now here we already have like a 30-35% of inflation built into this when we talk about the future numbers. So what sort of guidance would you give us in terms of, say, by next 3-year period? Where do we see this business reaching, building in the inflation?
So this is what we had covered as part of Project Leap when I presented to the investors after the March results. On 5-year basis, we expect that we will be able to touch almost 20,000 crore rupees of top line, where the core of our business will grow at 1.5x of the industry growth. We have factored in the inflation or movement in the commodity prices when we have computed this number of 20,000. But as I mentioned in the March call as well, allow us to come back to you with next level of detailing in the second quarter, where I would be able to give you additional color on these numbers.
Okay. So on the cable side, you don't see any sort of problem in terms of your demand, right? Like coming from the new factories being built, or all your demand drivers seems to be in place.
We are confident on the growth. India is a multi-decadal story, so it's not only at the company level, and even at the industry level, we are confident on the growth.
Got it. Okay, fine. Now, in the second question with the FMEG side, so we did around 192 crore top line this quarter, and compare with like in second quarter FY20 also we were around this level only, but there we did not go into loss. So is it that a large part of the price hike is yet to be passed on, and also we have a larger cost structure compared to the 2 years back? and that's why we have a loss in the FMEG?
Yeah, as I mentioned to the earlier participant, it's primarily because of increase in fixed cost, and that is also increase in the employee cost or the contractor cost. Last year we didn't give any increment to our employees, which was given this year, and this was slightly more than which otherwise you would expect on an annualized basis. So that is one reason. The second is the A&P spend has slightly increased, and A&P predominantly is for our B2C business. Of course, B2B business gets a bit of a rub-off effect of A&P, but primarily it is for B2C. So these are two main reasons because of which the margins, EBIT margins have gone into a negative trajectory. But I'm still confident of the guidance which we provided in the last call, that in 2 years period we should be able to get to a high single-digit EBIT margins for FMEG business.
Okay, great, sir. Good to know. I'll come back in the queue again, sir. Thank you.
Thank you. The next question is from the line of Rahul Agarwal from InCred Capital. Please go ahead.
Hi, good afternoon, and congratulations for a decent set of results. I had two questions. Firstly, wanted to understand contribution margins a bit better for Polycab. So to start with, is there any link between copper prices and gross margins? Because, we as analysts try to link that, and quarter on quarter, obviously, as you said, it's better to understand on an annual basis. But overall, is it fair to say that a rising commodity scenario where copper is going up, gross margins fall, and it's vice versa, it's true? Is that correct?
Not really. As I mentioned to Ravi as part of his first question, we have broadly 2 or 3 types of businesses within cable and wire. I'm talking from channel perspective. One is distribution, where we factor in previous month's foreign exchange rate, USD/INR foreign exchange rate, as well as copper LME, and revise the list price. The second was export business, where the dynamics could be different, where you quote the price and then accordingly price it. And third is institutional, where generally you take back-to-back quotation. So these are 3 things which we follow consistently. At times, you take calibrated approach in the pricing, and this is what was done in the current quarter as well. The increase in raw material cost at the basket level was almost in early teens, whereas the price hike which were taken in the current quarter was just touching the double digit, and that is where you can see a delta or a negative delta on the contribution margin. But generally speaking, on annualized basis, we have not seen significant difference in the margins, and that is what is important. And the other thing is, at times there is a mixed change. If you are attending customers which are far away from your plant, you end up incurring some additional freight costs. And if there's an increase in the export business, which is generally there in few of these quarters, the freight incident also plays in. So there are few dynamic factors, but Rahul, you are aware about this. We are probably the largest consumer of copper in India, and we have pricing ability to price the copper at the most appropriate time, and that is where we don't generally see any significant risk because of the risk management framework which we have in place.
Correct. So fair to say that the normalized level of 25% obviously comes back as and when the entire pricing thing is passed through, and overall we see a normal sale environment in India. Broadly, we should be back in terms of cable and wire. Gross margin should be back to normal levels. Fair to say that?
Absolutely.
Okay. And second question was on inventory. At 2,600 crores looks very higher than normal for Polycab given the history. And debtors at 900 crores obviously looks very low versus history, versus normal levels. Could you help us understand this change?
Yeah, so both of these numbers are not sustainable. Let me deal with receivables and then I'll come back to inventory. After softening of copper prices in mid of June, slowly sales started getting impacted adversely, and that is where we continue to collect on the outstandings of the sales which were made in the earlier months, but there was a dip in the overall sales in the month of June, and that is where the number of days of receivables or the absolute amount of receivables is likely looking lower. I don't think it's a sustainable number. Of course, with the help of channel financing penetration, we would be able to bring it down, but not on the basis of what we just experienced in this quarter gone by. On inventory, I think 2-3 things. One is since softening of copper prices adversely impacted our sales, it has indirectly resulted in increase in our finished goods. And second is we were expecting and we are still expecting that in the quarters to come, we will have uptick in demand. And this is what, if you recollect, we experienced even in last fiscal, where the Q2 was better than Q1 and H2 was better than H1. So that is where there is slight aberration in our inventory levels. As I mentioned in earlier quarters as well, inventory continues to be a focus area for us. We learned that during the IPO phase as well, that working capital is the area where we can do better, and I completely believe that we can do that better. In the quarters to come, we should be able to normalize it and have a better handle on it.
So there is no case of, so obviously there is some build-up because of temporary issues, which will obviously normalize over the next 9 months. And broadly, there is no case of inventory write-offs, right? It's never happened in the history, right?
Never ever.
Okay, perfect. Thank you so much. All the best, Gandharv. Thanks.
Thank you very much.
Thank you. The next question is from the line of Devansh from SIMPL. Please go ahead.
Hello. Yes, sir. Thanks for the opportunity. So just wanted to understand on two opportunities. One is EV cables and second is the telecom cables, which can be for 5G next year. So in both, if you can just elaborate on the technological preparedness and the manufacturing preparedness as of now, and how are we, seeing this opportunity, and what is the kind of interest that we have in participating in these opportunities?
So I'm sure you would have the telecom division which we have. We already have optical fiber manufacturing facility, and we have executed several projects, one in Gujarat, another in Bihar, on optical fiber. We are slowly and gradually expanding on our telecom footprint. These are early days to give you any specific guidance, but we remain, positive on the overall growth potential of this particular vertical. And as I mentioned as a response to one of the questions, I think by the second quarter we should be able to come back to you with nitty-gritties of few of these items where we can give information publicly.
Okay. That's it from my side. Thank you.
Thank you very much.
Thank you. The next question is from the line of Atul Tiwari from Citigroup. Please go ahead.
Yeah, hi, Gandharv. Thanks a lot. Again, one question on margins. I'm just trying to understand sort of volatility that we have seen in this quarter. So from the time when this commodity rally started, how much your RM costs have gone up in percentage terms, and how much price hikes you have taken, and how much more price hike you need to take to kind of fully pass on everything. So that is one. And if you could just kind of walk us through that, why did company not take enough price hikes to kind of maintain, say 11 or 12% kind of margins? So why was there a bit of a mismatch? I mean, we understand that on a full year basis, the mismatch will be kind of made up, but why it could not happen during the quarter? What was the operational issue or static reason behind it?
Sure. So probably, Atul, you will feel like I'm repeating what I mentioned to another participant, but in the current quarter, at the RM basket level, the cost price increase both of copper, aluminum, and other raw materials put together was in low teens, whereas the price hike which we have been able to take was almost touching the double digit, and that is where there is a negative contribution delta which you are seeing in the P&L. Now, the specific in the current quarter, what happens is when you're working in a dynamic period where you want to manage both profitability as well as top line growth, at times you take decisions of balancing the two with an assumption that higher sales will help you in getting better margins at the EBITDA level. What do I mean by that is, if I am able to increase the top line, I would be able to utilize my plant more effectively. That would mean that my fixed cost absorption would be better, and that is where the EBITDA margins would be slightly better. So it's a play between contribution and EBITDA, and at times we do that. And this quarter was also one of those quarters where the pandemic impacted several of the geographies. We have all types of cables. We have retail wires as well as we have cables which are used by industrial houses, B2B products and all that. So all of those reasons have impacted the margins slightly in the current quarter. But as you would have seen even in the last year, the H1 margins were slightly lower at EBITDA level. But on annualized basis as well as if you consider the H2 margins were better. So we are still confident of going back to our normal margins as we progress in the current quarter.
Okay, great. And just one last one. What will be the number of dealers and distributors and the retail touch points that the company is reaching now? And what are some of the medium-term targets on that? And how much of that channel is now covered with channel financing? That is my last one.
So we are around 4,000 all dealers and distributors at the country level and around 165,000, 170,000 retailers. In terms of channel financing and cable and wire, we are hovering around the same percentage of 65-70. However, in the case of FMEG, we have been able to make some progress there, and now we are hovering between 25 to 30%. We are hopeful that in FMEG we will be able to further penetrate channel financing and improve this by the end of the year.
Okay, great. Thank you. And that's all.
Thank you.
Thank you. The next question is from the line of Charanjit Singh from DSP Mutual Fund. Please go ahead.
Yeah. Hi, sir. Am I audible?
Yes, you are audible. Charanjit, please go ahead.
So just one thing. One, in terms of in our overall business split, what is the proportion which is coming from the institutional segment? In terms of general, price hike, when we talk about in the institutional segment, at what pace it follows, is it coming with a big lag? Because generally in the other normal channels, what we've seen is that pricing is being passed on at a very rapid pace in the cables and wire segment, especially. So how the pricing mechanism works, especially for the institutional side?
Thanks, Charanjit. That's an important one. So generally around 85% of our business is distribution and 15% is 85 is distribution and 15% is institutional. Institutional generally, you take the copper price as and when you get the approval on the sales from the institutional client, which means practically back to back, and that is where there's no lag. The lag which I was talking about on a monthly rest was for distribution business, where you increase the list price on a monthly rest after factoring in the LME as well as foreign exchange rate which was there in the previous month. But there is no such mechanism in the case of institution. It's order on order basis, and generally we take back-to-back position on the basis of orders confirmed by the client.
Okay. And so now you also talked about this initiative with BCG on GTM and various other initiatives. So if you can just elaborate in terms of by when we see that our targeted goal, which we have, to achieve with these initiatives, what's the target timeline? And if you can elaborate one on the GTM and any initiatives which are also on the cost front, which you are trying to do through these consulting firms.
Sure. Thanks, Charanjit. So there are three initiatives which we are running as of now. One is Project Udan, which we embarked on almost a year back, which is a cost optimization initiative. The entire cost base of the company is within the purview of this particular program, and we have already identified saving potential translating to 80 to 100 bits, and these initiatives are in the process of implementation, and we should expect getting credits to our P&L accruing over the period of 1 or 2 years. That was the first on Project Udan, which is cost optimization. The second one is which is a multi-year transformational program. The end objective is to get to 20,000 crore of top line by the end of fiscal 26, which is 5 years, and which is slightly more than double of what we achieved in fiscal 21. This covers almost all the facets of the organization, not only GTN, how we are going to shape the B2B, B2C, what type of processes we will have, what type of digital footprint we'll have, what type of organization we'll have, what type of new product categories that we decide to enter into, we will get to. And in the March quarter, I had mentioned that by Q2 of this year, we'll come back to all of you and highlight the progress. And the third one is Project Shikhar, which is again our distribution program where we want to penetrate identified geographies and ensure that we are able to get higher share of wallet or higher share of sales from the identified distribution targets, which primarily would include channel expansion, having engagement with the influencer and the experts program, and this program will cover almost 300 cities in next 2 years.
Okay. So just lastly on the fan side, so our mix in terms of the base versus the value versus premium, what is it right now? And in terms of the insourcing versus outsourcing, how it will change in the next 1 year time frame?
So premium fans are now almost in high teens, and this proportion as we go along would go up. Most of the fans are getting manufactured in our Roorkee facility. We are also in the process of augmenting fan manufacturing facility, and another facility is getting erected in Halol in Gujarat and expected to be operational later in the current year. There is very small amount of fans which are manufactured with the help of third-party suppliers, but their contribution to the top line at this stage is significant. Most of it, or almost all of it, is getting manufactured in-house.
Okay, so that's all from my side. Thank you.
Thank you.
Thank you. The next question is from the line of Ankur Sharma from HDFC Standard Life Insurance. Please go ahead.
Hi sir, good morning. Rather good afternoon. Just a few questions. First on our Q1 numbers in the cable and wire segment, how much was the volume growth and how much was the price growth in that 97% growth that we've shown on the top line?
Thanks for asking this. In our business, slightly difficult to compare that way because 1 kilometer of aluminum cable will cost significantly different if you compare that same cable if it is manufactured with copper. And that is where volumetric data is not necessarily the best way to analyze our company's performance. If you were to analyze our performance, there are 2 or 3 ways. One is, of course, you can check peer performance and our performance. And second is you can check what is the movement in LME prices and foreign exchange rate and compare that with our growth. Volumetric data will probably give you misleading information.
Okay, fair. So differently, I think you said wires haven't done as well as cables during the quarter. So what was the mix of wires and cables in this quarter?
There is no significant change in comparison to previous quarter. We are broadly in the same range.
Okay. Fair.
So in numbers, it would be around 50-51% types.
Okay. And so I think on the margin outlook, you said that, while Q1 obviously margins were fairly weak because of the lag in price, passing on the higher copper and RM prices, what do you believe would be a more sustainable number, say 22, 23? Do you go back to that 12% kind of EBIT margin range? Is that the number you have in mind?
So on an annualized basis, generally we have been talking about 11 to 13% of EBITDA margin, and if you see fiscal 21, we were able to beat that guidance. But as I mentioned to others, that we are working on Project Leap, and give us time till second quarter. It's quite possible that we will be able to give you more granular information on Project Leap, and then on actual basis, on half yearly or yearly basis, we'll come back to you and update you on the actuals against that guidance.
Okay, fair. And just one last one, if I may, and I think this was discussed earlier in the call as well, in terms of a recovery in demand on the cable side. So if you could just talk about, are you seeing large projects on the manufacturing side, on the infra side, any pickup over there? So primarily on the B2B, that is, starting to happen, which kind of gives you confidence that over the next few quarters you start seeing a fairly sizable pickup on the cable business. So if you talk about either the inquiry levels or how is the current demand situation?
You're right. So overall, in the current quarter, the institutional business has picked up. Having said that, the larger projects are probably still on a slow track. But the smaller projects, we have some visibility, and that is where we can see a bit of uptick in demand, both at order level as well as at execution level in the institutional side of the business. Having said that, I don't think we have reached to the pre-COVID levels, and we'll have to wait for some time before we finally conclude whether we have reached to the pre-COVID levels or not.
Okay, great. Okay, sir. That's all from my side. Thank you.
Thank you.
Thank you. The next question is from the line of Sanjay Satpathy from Ampersand Capital. Please go ahead.
Yeah, hi. Thanks a lot for taking my question. You have mentioned about your margin, which way that we should not really look at quarter one and look at the full year. And then you have mentioned that your margin was affected because of the copper price volatility. Can you just tell us that whether all those are behind us, that is copper price are stable and your pricing actions are more or less done, and so that way Q2 will not have any such exceptional situation which was there in Q1?
Yeah, so let me just explain the business model so that you are able to appreciate what we are doing here. 85% of our business comes from distribution. In the case of distribution business, the list price is generally revised on monthly rest. And when we do that revision, we factor in two things. One is change in LME prices in the previous month as well as change in exchange rate. So there is a 1 month lag which is there. And at times in dynamic situation like these, you take calibrated approach while balancing the price hike as well as and profitability and as well as the top line growth. This is what we have witnessed. But generally in our experience, generally speaking, pluses and minuses are offset within the fiscal. And if you see on an analyzed basis, the margins are not significantly different from earlier periods. And that is what I was mentioning to the other participant, that if you take an analyzed view, you will not see significant change. But because of this 1 month lag and at times dynamic approach of balancing top line and bottom line, at times you would see some aberration between one quarter or the other.
No, that I understood. I'm saying that are those kind of behind us? It's just a small maintenance kind of a question from a near-term point of view. That is what I was trying to kind of understand. The second thing that I wanted to understand is that so it is your peers are also reporting results and their numbers and your numbers are appearing as very different. And I understand that it could be because of some technical factor like your geographical mix or many other such things. So what we really want to understand here is that your competitive position and your strategy of growth and gaining market share. Are you confident that you'll be able to kind of silence your critics or whatever you say sometime very soon, and you're fairly confident that you are doing better than your peers because you have a superior business strategy in terms of growth?
Thanks for highlighting that. So as I mentioned in my opening remarks, we remain absolutely confident and comfortable on our strategy and execution. We have any which was highlighted our ambition under Project Leap, which is 20,000 crore top line in 5 years from now, and growth in one particular product category of 1.5x of the industry and another product category of 2x. And I have no reasons to doubt our ability to achieve those numbers.
Okay. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Bobby Jairam from Falcon Investment. Please go ahead.
Hi, could you talk a bit about how you're going to penetrate the FMEG market categories like fan, given larger players like Havells and Crompton's are already well established? So what's your strategy? Is it pricing led or product led? If you could talk a bit about that.
Thank you. I'm sure you're aware we are already in top 6 or 7 in fans. We forayed into this business 5-6 years back, and since second or third year we are EBIT positive in fan business. We are working on several initiatives. One on the GTN. We want to ensure further penetration both at distribution and retailer level. Second is on the availability of our products across different pricing pyramids. Third is in-house production, which gives us confidence on the quality as well as the value for money for our consumers. You will be pleased to know that our field returns in fan are lower in the industry because of the quality, stringent quality parameters we have in place. And the another important thing is the recent initiatives both on the IoT side through Silvan and Home and the e-commerce initiative where we want to get to the next generation of the consumer. We are extremely positive on the uptick in the demand in the fan business for our company.
What is the IoT fans or appliances? What differentiates that from the products in the market?
There's a complete basket of offering where app-based products are available, which can be operated with the help of app or with the help of web. And this is not only restricted to fan, almost all the products, whether you think of water heater, you think of lighting or fans, almost everything can be operated. And this is being marketed under the brand Home. The recent acquisition of Silvan will help us in getting to home automation, and that is where the entire home automation product portfolio will also help us in improving our FMEG product sales, which would include, among others, fans as well. And these are
automation.
And these are the products which are manufactured in-house, made in India, with strict quality supervision, and that is where the field returns are best in the industry.
Yeah, the question I have is whether this kind of automation is something that's demanded by consumers. Because even in advanced markets, I don't see these kind of products. When someone buys a fan, they essentially want a fan that is breezy, doesn't break down, and is priced reasonably. They don't want a lot of fancy